Welcome now. It's CEO. He is Mr. Jim Loree. So thank you so much for joining us, Mr. Loree. Give us your sense of where you are on the earnings.
Yeah, it's great to be here. So, we began the year with the guidance that had a midpoint of $10 of earnings per share. And over the course of the successive 2 quarters, that guidance went up to as much as $11.50 a share as the volume was exceeding expectations. And things were going extremely well. We did not have, the supply chain issues really did not emerge until back half of the the beginning of the third quarter. So we come into this earnings season, and all of a sudden we've gotten hit with about $230 million in the third and fourth quarter of excess costs, 100 related to inflation, and about 130 related to excess expediting and premium freight costs, container inflation, those types of things that are all related to the supply chain, and most of which we think is transitory. So one of the great things about this era for us is that we have pricing power, and so we have been able to implement price increase in the early third quarter, and then again a surcharge in the late third quarter, averaging 3 to 4% in the first tranche of the price increase, and then about a 5% surcharge in North America in the second wave, if you will. And so we're now covering about 100% of our inflation, and the inflation annualized that we've been dealing with this year is $1.3 billion. And think about that on a $14 billion base. Wow. It's a big number. And fortunately, we've been able to cover it with price. However, there's always a timing issue. I think we moved incredibly fast with great agility. However, there is a lag time. And so the fourth quarter earnings will be a bit lower than we expected before. The guidance goes from $11.50 down to $11 for EPS this year. And we introduced guidance for 2022, which is up $1. So earnings per share up $1. And what that says is over the last organic growth in the high single digits, basically, for next year. We also have $3 billion of acquisitions coming in next year, which relate to the outdoor power equipment market. And we intend to electrify that outdoor power equipment market. And so the combination of this really solid demand that we have, we're able to serve it. We've been serving it effectively. We hit our third quarter revenue, and the fourth quarter is on track for what we forecasted before, but the cost to serve is substantially higher. So we're covering it with price. When that abates, the excess freight and all that, we will be able to reduce the surcharge. But in general, it's a timing story. It's a great story from a growth point of view, and there's lots of growth ahead. We have some exciting new products that we introduced in the last couple of weeks and talked about on the earnings call and in the release. First major power tool player in the world to introduce pouch cell battery technology, 50% more power, 25% more compact, 15% lighter. Right. Just really a great product. It'll be out in the market here shortly.
Yeah. So Jim, let me come back to pricing power for a second, because I'm very curious about this. You're one of the few big multi-industrial companies that has exposure directly to the consumer as well as to the trade. Are you getting any pushback at all from either consumers or from the trade to price increases?
Well, you never get a price increase with the trade in my world without having some pushback. It's just the nature of the beast. The end users, frankly, in the home center arena, they're quite used to price increases at this point. I mean, you remember the horror stories of earlier this year, late last year, with the lumber prices, stratospherically off the charts and so on. And so many of the different building products categories have incurred price increases. And up to this point, we had not been compelled to do that, did not have to do that, and didn't do it. So I don't think it's going to be a huge backlash from the end user community. The innovation is there in our tool brands to justify the additional pricing, and certainly the cost increases that we're absorbing here justify it as well.
Jim, you mentioned the supply chain issues as being transitory. Define transitory for me. When do you see some light at the end of that tunnel?
Yeah, it's a very dark tunnel right now in terms of the clarity regarding when they might be resolved. And there's, as you know, there's anytime you have bottlenecks in a system, usually you can, if you can address one bottleneck. So let's say we address the ports bottleneck, the LA, Long Beach, 100 ships that are lined up out there. And so we are working with the White House and some of the big retailers and other manufacturers and a task force to help figure out how to reduce the congestion there. But then we're gonna need truckers, and we're gonna need trucks, and so on. So we have to continuously work on each one of the bottlenecks before we can get this back to an equilibrium. And I think that probably means, several quarters before it really gets resolved. But I think the good news is the administration has accepted the fact that it is a problem, and they are proactively working with union, with companies, and, with and themselves to, kind of team up and try to solve this problem.